Welcome back to Canada Accounting Insights. Today we're diving deep in the topic, investments in associates. We'll break down the equity method step by step, explore goodwill, acquisition differentials, bargain purchases, intercompany transactions, impairment, derecognition, and even compare IFRS and ASPE. This is a big topic, but I'll take you through it clearly with examples you can apply in both your CPA exams and real-world accounting. And before we dive in, don't forget to like this video and subscribe to the channel. It helps us reach more students and professionals looking to simplify complex accounting standards. Let's begin at the starting line, initial measurement. An associate is a company where the investor has significant influence, usually presumed when ownership is 20% or more. Under IFRS, significant influence means using the equity method. At acquisition, the investment is recorded at cost, debit investment in associate, credit cash. Straightforward. But here's the catch. The purchase price rarely equals the investor's share of the associate's book value. The difference is called the acquisition differential, and it arises because of fair value differentials. For example, land might be undervalued on the associate's books. Goodwill, the extra premium paid for expected future earnings. Now, investors don't just leave that difference floating in the air. They usually track it in an acquisition differential schedule, also called a goodwill schedule or purchase price discrepancy schedule. This schedule shows the breakdown between fair value adjustments and goodwill, and it's critical for subsequent measurement. Let's see an example. Suppose Maple Corp acquires 30% of Cedar Laminate for $201,000, including transaction costs. Cedar's equity is $400,000, and land has a fair value of $100,000 compared to a book value of $80,000. The acquisition differential schedule would show purchase price $201,000. Investor's share of book value $120,000, which is $400,000 times 30%. Acquisition differential $81,000, that is $201,000 minus $120,000. Allocation to land, fair value difference, negative $6,000. This is the land fair value $100,000 minus land, book value. $80,000 equals $20,000 times 30%. Remaining goodwill of $75,000. But remember, goodwill isn't recorded separately. The journal entry is just debit investment in associate $201,000. Credit cash, $201,000. That goodwill is embedded in the investment balance. Now, what if the opposite happens? You pay less than your share of the associate's net assets. That's called a bargain purchase. In that case, IFRS says you recognize a gain right away in profit or loss. Here's the entry. Debit investment in associate, credit cash, credit gain on purchase of associate. This increases the investment balance but also boosts income immediately. It's rare in practice, but examiners love to test it. So once the investment is recorded at cost and tracked with acquisition differentials, what happens next? That's where subsequent measurement comes in. Unlike passive investments, associates reflect an ongoing relationship. The equity method ensures the investment balance moves in step with the associate's performance. Here's the process. Add your share of the associate's net income. Subtract your share of dividends. Adjust for amortization of fair value differentials. Eliminate unrealized profits from intercompany transactions. This way, the investment account shows not just cost, but also how the associate's performance impacts the investor. For example, let's say Northern Corp buys 30% of Prairie Laminated for $453,000. Prairie earns $163,500 and pays dividends of $60,000 in year one. Northern's share of income is $49,050. But after adjusting for inventory and equipment fair value differences, equity income comes to $26,850. The journal entries are debit investment in Prairie $26,850, credit equity income $26,850. Then, when dividends are declared, debit cash $18,000, credit investment in Prairie $18,000. At year end, the investment balance is $461,850. But what if the investor and associate trade with each other? That's where intercompany transactions come in, and they can really complicate things. When goods move between the investor and associate, part of the profit may be unrealized if the goods remain unsold at year end. To fix this, we use the formula ending inventory times gross profit percent times investor ownership percent. This adjustment ensures income isn't overstated with profits that haven't been realized externally. Let's stick it with an example. Suppose Harbor Inc. owns 30% of Bay Limited. At year end, Harbor holds $20,000 of inventory purchased from Bay, and Bay's gross margin is 30%. Unrealized profit equals $20,000 times 30% times 30% equals $1,800. The entry is debit equity income $1,800, credit investment in Bay $1,800. Then, when that inventory is sold externally, the profit is recognized in the next period. Now let's look at what happens when the relationship itself changes, through impairment, losing influence, or stepping up to control. Investments in associates can be written down for impairment. Unlike direct asset tests, under IFRS, the investment is treated as a single asset. If the recoverable amount is lower than the carrying value, the loss is recognized. Derecognition happens when you sell or lose significant influence, and if you buy more shares and gain control, it becomes a subsidiary, triggering a step acquisition. Take Windmill Inc., which owns 40% of Tulip Limited for $500,000. Over 3 years, Tulip earns $620,000 and pays $80,000 in dividends. On January 2nd, year 4, Windmill sells 30% of Tulip for $597,000, leaving only 10%. With 10%, it no longer has significant influence. The retained 10% is reclassified as a financial asset at fair value, $199,000. Windmill records, debit cash $597,000, debit investment at FVPL $199,000, credit investment in associate $716,000, credit gain on reclassification $80,000. Now the reverse. Growing Inc. owns 30% of Camel Corp. with a carrying value of $822,000. On January 1st, year 2, it buys another 30%, 35% for $1,050,000. This pushes it from influence to control. The fair value of the original 30% is remeasured to $900,000, creating a gain. Debit investment in associate $78,000. Credit gain on revaluation $78,000. Then the step acquisition entry is debit investment in subsidiary $1,950,000. Credit investment in associate $900,000. Credit cash $1,050,000. From that point forward, Camel is consolidated, not equity accounted. All right, so now we've covered recognition, measurement, intercompany adjustments, and changes in ownership. But how do we actually present this in the financials, and what needs to be disclosed? On the statement of financial position, investments in associates appear as non-current assets. On the income statement, the investor shows its share of the associate's profit or loss as a single after-tax line. And in the notes, IFRS 12 requires details: name of the associate, ownership percentage, summarized financials, and any restrictions on cash transfers. These disclosures help users understand the impact and risks of the associate relationship. Before we wrap up, let's highlight the key differences between IFRS and ASPE. Under IFRS, the equity method is mandatory, but under ASPE 3051, private companies have a choice: equity method or cost method. If the shares are publicly traded, then it's either equity method or fair value. One key ASPE difference: when more shares are acquired but you still have significant influence, the old shares are not remeasured. They just carry forward at cost. So here's the big picture. Investments in associates start at cost, with acquisition differentials tracked. Bargain purchases lead to an immediate gain. Each year we adjust for income, dividends, fair value differentials, and intercompany profits. Impairment, derecognition, and step acquisitions change the treatment, and ASPE gives private companies more flexibility. If you can walk through an example covering these areas, you'll be well prepared for exams and professional practice. Thanks for watching. If this video helped make investments in associates clearer, Give it a like, drop your questions in the comments, and subscribe for more insights into IFRS, ASPE, taxation, and finance. I'll see you in the next video.